I asked you what kind of video you want to see after my 2-week holiday, and you answered with the best dividend stocks to buy right now. So here we are. In this video I will show you 3 great dividend stocks that are worth buying in my opinion. Of course, this is no financial advice and you should always do your own research. And to be honest, I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. First stock on this list is Qualcomm, ticker symbol QCOM. This stock is up 8.8% year to date and it has been a bumpy ride so far, with the highest point at almost $140 to the lowest point all the way down to $100. Qualcomm missed on EPS by a small margin, but beat on revenue in the most recent earnings report. However, for the upcoming earnings, all analysts think Qualcomm will miss their target, which could make them an interesting buying opportunity. If we check some basic fundamentals, we see that Qualcomm is a 130 billion market cap company. PE ratio is at 12, which could indicate that they are undervalued. Revenue is at 41 billion and in this graph we see that revenue went up in the long run. However, it has some ups and downs and most recently revenue started to slow down as well. Over a longer period of time we see that margins are pretty steady, which is a good thing in my opinion. Another thing that I really like about Qualcomm is the return on assets, return on equity and return on invested capital. All these numbers look fantastic. The only bummer is that the current ROIC is lower than the 5-year average, but it's still a really good number right now, so just keep an eye on this number. Current ratio is at 2.42, which looks pretty decent to me, and debt is at 16 billion, while cash is at almost 7 billion. I prefer companies that can pay down at least a third of the total debt, so this looks very good to me. Free cash flow is going up in the long run, but it's not really steady and consistent, so that's something to keep your eye on, especially with the recent decrease. And it's of course very important that free cash flow is growing, since this is used to pay down debt, buy back shares, pay dividends and all other things. Qualcomm is buying back a lot of shares, which makes it easier to maintain and increase the dividends, so this looks really good to me. Dividend yield is at 2.82%, which is a great number. Annual payout is at $3.2 and payout ratio is at 28%, which is below my 50% maximum. This means that right now Qualcomm has 72% left in cash to pay down debt, buy back shares and do all other things. The 5-year growth rate is at almost 6%, which is also a decent number, but nothing spectacular to be honest. They grew the dividends for 19 years in a row, which is really impressive. In this graph we see that payout ratio has been decreasing in the past couple of years, which is a good thing. To me this looks really good and 28% is also a great number. And in this graph we see the expected dividends in the coming years by the analyst. So it's just a rough indication, but it's expected that dividend will grow roughly in the same growth numbers as the past couple of years, which is fine by me. My final conclusion on the stock is that with the current stock price, Qualcomm might be a great long-term dividend play in your portfolio. Revenue might be slowing down a bit, but right now, with everything happening around AI, Qualcomm could play a huge role in the future. Both from a dividend point of view and a value point of view, Qualcomm looks really interesting. For now, I'm slowly adding more shares throughout the year and try to keep my cost average as low as possible. Second stock on this list is Texas Roadhouse, ticker symbol TXRH. This stock is up 15% year to date, outperforming the S&P 500 by a small margin, which is up 13% year to date. Texas Roadhouse missed on EPS by a small margin, but beat on revenue in the most recent earnings report. However, for the upcoming earnings, analysts have mixed feelings about the numbers. This stock gets a lot of attention lately by different YouTubers, and I get why. It's also one of my favorite dividend growth stocks as well. And if we check some basic fundamentals, we see that TXRH is a 7.2 billion market cap company. PE ratio is at 26, which could indicate that you pay a premium for the stock. And don't get me wrong, I would love to see a lower PE ratio, but the restaurant business is rapidly growing and even after the lockdown periods they really took off, which might justify a higher PE ratio. especially since there is a lot of growth left, of course. Revenue is at 4.17 billion, and in this graph we see that revenue went up in the long run. I really like to see this steady and consistent pattern for a restaurant business. And this is also one of the reasons why people love this company so much. Over a longer period of time we see that margins are growing very nice and steady, which is really good for a restaurant business. Of course, there was this major decline during the lockdown periods. Another thing that I really like about TXRH is the return on assets, return on equity and return on invested capital. All these numbers look fantastic. Current ratio is at 0.46, which looks pretty good to me, and debt is at 700 million, while cash is at almost 160 million. I prefer companies that can pay down at least a third of the total debt. So this isn't the case right now, but to be honest, these numbers doesn't worry me a lot. Free cash flow is going up in the long run, and it's pretty steady and consistent. And it's of course very important that free cash flow is growing, since this is used to pay down debt, buy back shares, pay dividends and all other things. TXRH is buying back a decent amount of shares, which makes it easier to maintain and increase the dividends. So this looks really good to me. Dividend yield is at 2%, which is a decent number. Annual payout is at $2.2 and payout ratio is at 46%, which means it's below my 50% maximum. This means that right now TXRH has 54% left in cash to buy back shares and do all other things. The 5-year growth rate is at 18%, which is also a great number. And one of the reasons why I love this stock so much. During the lockdown periods they cut the dividend, which seems like a smart move in my opinion. So that's why there is no dividend growth in terms of years. In this graph we see that the payout ratio has been pretty steady in the past couple of years, which is a good thing. Of course there was a decline in payout ratio due to the dividend cut. And in this graph we see the expected dividends in the coming years by the analysis. It's just a rough indication, but it's expected that dividend will grow in high numbers in the coming years, which is very nice. My final conclusion on this company is that I really like the management decisions. Cutting the dividend during lockdown period seems like the only smart thing to do. And growing this business so steady and consistent in a tough industry is also very impressive. For now I will keep buying more shares of Texas Roadhouse, since both from a value point of view and a dividend point of view, things look pretty good. Third stock on this list is Realty Income, ticker symbol O. This stock is down 6% year to date, and that's already one of the reasons why I included this REIT in this list. Most people start buying Realty Income stock around $60, and so do I. Realty Income beat on FFO by a small margin, but missed on revenue in the most recent earnings report. For the upcoming earnings, analysts have mixed feelings about the numbers. If we check some basic fundamentals, we see that Realty Income is a 39.5 billion market cap company. PE ratio isn't the correct way to value a REIT, so I will be using the price to FFO instead. Right now it is sitting at 14.8, which could indicate that they are undervalued. Revenue is at 3.48 billion, and in this graph we see that revenue went up in the long run. As of lately the revenue really took off, which is also very nice. Over a longer period of time we see that margins are decreasing, which is something to keep your eye on. Current ratio is at 2.81, which looks pretty good to me, and debt is at 19 billion, while cash is at almost 180 million. I prefer companies that can pay down at least a third of the total debt, so this isn't the case right now. But to be honest, these numbers don't worry me that much, since REITs issue a lot of new debt in order to grow the business. Free cash flow is going up in the long run, and it's pretty steady and consistent for a REIT. And it's of course very important that free cash flow is growing, since this is used to pay down debt, buy back shares and do all other things. Realty Income is issuing a lot of new shares in order to raise capital and grow the business. This is very common with REITs, so it doesn't worry me at all. Dividend yield is at 5.2%, which is a really good number. Annual payout is at $3.07 and payout ratio is at 75%, which is the standard for REITs. So again, this doesn't worry me at all and looks pretty good. The 5-year growth rate is at only 4%, but for a REIT it's pretty decent, especially with dividend yield this high. They grew the dividend for 26 years in a row, which is also very impressive. And last but not least, they pay a monthly dividend instead of a quarterly dividend, which is also very nice. My final conclusion on this stock is that I really like the growing business and the historical track record. It's a great read and if not the most popular one. And of course with reason. For now I'm adding more shares and I'm planning to double my position in the coming months if the stock stays at these prices. And this was the full list of 3 dividend stocks to buy right now. All these 3 dividend stocks are in my portfolio right now, but that doesn't stop me from buying more shares. However, there are of course more stocks out there that should be mentioned in this video, so here we go. First interesting stock that I didn't cover in this video but earned some attention is Starbucks, ticker symbol SBUX. The stock price is falling lately and the upcoming earnings could be impacting the stock price as well. Dividends look really good with dividend yield at 2% and the 5-year growth rate at 12%. Next stock is Williams-Sonoma, ticker symbol WSM. My most recent buy, and I will do a full analysis very soon. Dividend yield is at 3% and payout ratio is at only 20%. The 5-year growth rate looks really good at 15% and they grew the dividends for 16 years in a row. Very impressive. The next stock is Tractor Supply, ticker symbol TSCO. Dividend yield is pretty decent at 1.88%, but take a look at the 5-year growth rate of 28%. Soon a full analysis. Last stock is Nike, reporting earnings very soon, so definitely a stock to keep your eye on. Dividend yield is decent at 1.24%, but with payout ratio really low and a decent growth number, this could be an interesting dividend growth stock. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.